Hello and welcome to this session in which we will discuss capital asset when it comes to governmental accounting. The governmental accounting standard, GASB statement number 34, mandate that all capital asset, including infrastructure, be reported in the government-wide financial statement. Why? They want the government to give a comprehensive view of its financial position, which should include capital asset, including infrastructure. Now, I just want to clarify one point. No long-term or capital asset are reported in governmental fund that uses modified accruals because these governmental funds use current financial resources. And current financial resources are different than economic resources measurement focus, which focuses on everything. Current financial resources don't include long-term assets, long-term liabilities. So what we are discussing here has nothing to do with governmental funds, special revenue funds, the debt fund, the capital project fund, because you might be confusing the capital project with capital asset. Capital project don't include capital asset, neither the debt service fund that financed their capital project. I just want to make sure I clarify this from the get-go. Let's go ahead and get started on how to account for capital asset under governmental accounting. Before we proceed any further, I have a public announcement about my company, farhatlectures.com.
Farhat Accounting Lectures is a supplemental educational tool that's going to help you with your CPA exam preparation as well as your accounting courses. My CPA material is aligned with your CPA review course such as Becker, Roger, Wiley, Gleam, Miles. My accounting courses are aligned with your accounting courses broken down by chapter and topics. My resources consist of lectures, multiple choice questions, true-false questions, as well as exercises. Go ahead, start your free trial today.
First is the valuation. What's valuation? Initially, when we purchase an asset, how would we report this asset? When valuing capital asset, it's essential to account for the asset for all costs that get the asset for its intended use beyond the purchase price. Simply put, just like GAAP, when you buy an asset, it's the purchase price plus any necessary cost to bring the asset for its intended purpose. This includes transportation, installation, modification, anything that get it ready for its environment. It's a historical cost. Nothing should be different than the GAAP that we know for a private company when they purchase an asset. How about if we build a building, rather than purchase a building, we did the construction ourselves and we incurred interest. Now the rules here are different than the accounting for-profit businesses. For-profit business is what? Interest during construction is capitalized. What does capitalized mean? It means add to the asset. It's part of the historical cost. Well, GASB 34, interest accrued before the completion of the construction does not become part of the historical cost. So this is different. Instead, these interests are treated differently depending on the type of the financial statement being prepared. What does that mean? If we are reporting this information in the government-wide financial statement, and the government-wide financial statement use full accrual, which means using the economic resource measurement focus, we would record this as an interest expense. So any interest expense is reported separately as an interest expense. Well, how about when we prepare the government fund financial statement? So for the financial statement that adhere to the current financial resources, it means they are using the modified accrual, interest cost is displayed as an expenditure. So how do we report interest cost in these type of funds? As an expenditure. And when we learn about modified accrual, I showed you how you report something under the government wide versus reporting this on the government fund financial statements. How about infrastructure? Well, infrastructure are a critical component of the government capital asset. What do we mean by infrastructure? The government would, in quote, own the streets, the bridges, the gutters, similar structure that are essential for public service. Now, these assets should be categorized as capital asset in the governmental fund accounting. However, one more time, they are not included in the government fund in the modified accrual. They're only reported in the government-wide financial statements. And why? Because the government-wide financial statement uses which focus? Uses the economic resource measurement focus. The fund uses the current financial resource measurement. So that's why they are excluded in a sense that are only reported on the government-wide. What do we have to do when we have those assets, the infrastructure, the capital asset? What is the required approach? Well, any asset that meet the definition of an asset, we have to capitalize and report in the financial statements. Which financial statement? Once again, government-wide financial statement. And when we report it in the government-wide financial statement, we also have to report depreciation. That's the required approach. Now we have a required approach and we have an alternative approach. So the required approach is you depreciate this asset. And this accounting treatment recognizes the diminishing value of the asset over time. Remember, the government don't depreciate something for tax deduction. They don't pay taxes on it. They're not planning to reduce their taxes. That's not the purpose. The purpose is this asset is being diminished over time. As a result, because of the obsolescence and use, you depreciate this asset. Now, when you depreciate assets, well, it's essential to assign the depreciation expense to the appropriate functional category. What does that mean? So for depreciation, a fire truck, a police car, those should be included in the public safety expense. Why? Because that's going to help that function of the government prepare budgets, prepare financial analysis. Let us know more about this department, this unit, in terms of accountability. Now, this is the required approach. What's the required approach? You have capital asset, you record the capital asset, you depreciate the capital asset. Why do you do that? To show the diminishing value of the asset over time due to use and obsolescence. How about the modified approach? Well, there's an alternative way. Rather than depreciating the asset, the modified approach provides an alternative way to account for certain infrastructure, especially those that are part of a network or a subsystem of network referred to eligible infrastructure asset. Think about roads, bridges, tunnels, drainage system, water, sewer system, dams, and other infrastructure. For example, the roads. Okay, you have the roads. Who are you going to allocate the expense if you're going to depreciate the roads? Who are you going to allocate the expense to? Or the bridges? To which section of the government, right? It gets a little bit more challenging to allocate. So you have the option not to depreciate those, what we call eligible infrastructure assets. Eligible infrastructure assets that are part of a system. They don't stand alone. Like a police car, it's a police car for the police department, for public safety. We know that asset separately. But roads, is it for the police department? Is it for the inspector's office? Is it for the fire department? It's for everyone. It's part of an infrastructure. So you don't have to depreciate those eligible infrastructure assets as long as you meet certain conditions. What are those certain conditions? One is you have to keep a proper inventory of these assets. Details the condition of the government infrastructure. What does that mean? List the asset with conditions rating like good, poor, medium, organized by type, and assessment date, given a clear view of infrastructure asset. Okay, you don't want to depreciate the asset, that's fine. What should the government do? They should have a list of all their asset, basically a list of all their asset. How often do they inspect the asset? For example, a bridge. What's the condition of that bridge? Is it good? Is it poor? Tell me, what type of assessment do we need? Do we need to fix that bridge? What's the condition of that bridge? Now, why are we doing so? We are doing so because we want to keep track of the asset of the government, but we're not going to depreciate the asset. We're just going to keep good track of it. Two, you want to compare estimated versus actual maintenance spending. So after you assess these eligible infrastructure asset, you're going to spend some money. Well, you want to show me how much you estimated the cost to be versus how much it is actual cost is. Why are we doing this? Because we want to assess funding adequacy. How much are we spending money on these assets? And identify spending trends. Are we spending too much money on that bridge in terms of infrastructure? Do we need to just basically build a new bridge or find an alternative? So that's the reason. So you're not depreciating, you're not showing the usage, you're not showing the wear and tear, you're not showing the obsolescence. That's fine. If you don't want to do that through depreciation, you want to keep track of the assets separately, assess them on a regular basis. Every year or every 2 years, whatever schedule you have, go check those bridges, those roads, the sewer system. What type of maintenance do they need? Keep track of that. And you're going to see those two conditions will also be disclosed later. How about when we incur additional expenditure on these eligible assets? Well, we have two options. One is to expense them. Typically, ongoing maintenance expenditure for these infrastructure are reported as an expense. And this reflect what? This reflect the immediate consumption of the resources in maintaining the asset service potential. Simply put, is if you are maintaining something, maintaining the bridge, maintaining the roads, and just maintaining them, you're not improving them, you're not adding to their life, you expense those expenditure. However, if you are incurring expenditure that result in significant additions or improvement, well, then these costs are capitalized. For example, now you upgraded the bridge. Maybe you installed a toll on it. Well, this is, what do you have to do with this expenditure? You capitalize it, you treat it as an asset. This means that such expenditure are recorded as an increase in the asset value on the balance sheet, reflecting the enhancement of the asset service potential or extension of its useful life. Just like also for financial accounting, when you spend money on an asset, you might either expense this money or expense that cost or capitalize that cost. What do you have to report when you have the modified approach? So if you're using the modified approach, what do you have to report? You have to report two schedules in the supplementary information. And guess what? The repeat of the requirement. List the conditions of the infrastructure assets like roads and bridges rated as good, fair, or poor in the time frame of the assessment, providing a snapshot of the infrastructure physical state. Well, why do you have to do that? Because one of the conditions to be using the modified approach is doing that step. What's that step? Inspecting that infrastructure on a regular basis, also showing me the maintenance cost against the actual expenditure, including any variances you are performing. So these schedules, the purpose of the modified approach is to highlight the government infrastructure stewardship and transparency. So they're the owners, but they're telling us what's going on with these assets. How about what happened when you switch from the modified approach to the required approach, or from the required approach to the modified approach? Switching between those two methods, switching between the depreciation and the modified approach, is considered a change in estimate. This transition emphasizes the asset maintenance. So if you're going to the modified approach, you're saying I am maintaining this asset rather than depreciating the asset. Now, bear in mind, if you are going the opposite way, if you're going back to depreciation, you are reintroducing the wear and tear, the cost allocation over time, which is showing the deterioration of the asset in form of depreciation. Now, both changes, whether you go from the modified to the depreciation, from the depreciation to the modified, is treated prospectively. In other words, you don't have to go back and change prior financial statements. And this ensures consistency in the financial statements while accommodating shift in the asset management. Now, of course, you have to disclose this. You have to disclose what's happening. Now, one more topic we have to be familiar with is impairment. Because when you have assets, those assets could get impaired. Impaired when the asset lost utility. It could use utility for many reasons. So how does the government record impairment? For example, it could use utility from physical damage. Like a storm happened, vandalism, for example, the storm destroyed the traffic light on the street. Or somebody broke into the government offices and they stole something, or they broke something. Restoration costs are estimated to restore the asset, reducing its book value to reflect impairment. So if the loss was due to a physical damage, you reduce the book value to reflect the impairment. If the loss was due to illegal obsolescence or enactment of laws, what does that mean? Let's assume we have a new law where we have to use now electric vehicles for all the government business. Well, guess what? We have vehicles that are what? That uses gasoline. As a result, they lost utility. They are impaired. So service units approach estimate the loss by comparing available productive units before and after the impairment, adjusting the asset value for reduced utility. So you'd say, okay, because of this environmental law changes, this environmental is misspelled, what's going to happen is this: I am going to reduce my asset based on that. For example, reduce my traditional vehicles. It could be also reduce utility or asset life. For what reason? Just change in technology. This approach assesses service capacity decline, adjusting the balance sheet value of the current utility and life expectancy. For example, you have fleet of buses that are expected to last 10 years, but need to be replaced after just 5 years because they lost utility, there's a change in technology, they're useless at this point. So what happened is you'd have to reduce their current value on the balance sheet based on the reduced utility. Now bear in mind, if you have any insurance recovery, you will offset any maintenance or offset any impairment loss. This ensures that the financial statements present an accurate asset value for clear reporting and informed asset management. Simply put, if this computer was destroyed, you'd say I have to write it down by $1,000. But here comes the insurance replacing $800. Well, you only have to write it down by $200. So simply put, insurance will recover some of that impairment loss. Let's take a look at a multiple choice question from Farhat Lectures. What is the modified approach in accounting for infrastructure assets? So what is the purpose? What is this modified approach? Is it to depreciate the asset over its useful life? Is that what the modified approach is? Absolutely not. The modified approach is an alternative to depreciation. So therefore, we don't depreciate the asset under the modified approach. Is it recording the asset at historical cost? That's a true statement. But it has nothing to do with the modified approach. You always record the asset at historical cost, whether you are using the modified approach or you are using the depreciation method. So that's out. Maintaining the asset at specified condition level without depreciation. Is this the modified approach? Yes, this is the modified approach. Under the modified approach, capital assets are not depreciated. So if they're not depreciated, well, what are you doing then? Well, I'm going to maintain the asset at specified condition. How do I maintain this asset at specified condition? I will assess the asset. I will take a look at the asset. I would review it, making sure it's still in good condition or a decent condition. If not, I will have to maintain it. And if I maintain it, I have to show the users how much am I estimating the maintenance cost and how much of that actually spent on that maintenance cost. So revaluing the asset annually based on fair market value, we don't have to do this for government. There is no such thing as revaluating the asset at fair market value. Therefore, the answer is C as in Charlie. What should you do now? Go to Farhat Lectures, look at additional MCQs. That's going to help you do what? Do better in this topic. Governmental accounting, CPA exam, your accounting courses. Invest in yourself. Invest in your career. Don't shortchange yourself. Good luck. Study hard. Accounting is worth it. And stay safe.